So we're going to be starting Module 4. Now, to tell you a little bit about Module 4, Module 4 is on sales contracts, both domestic and international. And what's interesting about this is that obviously this could be more, it's really just an extension of the long module 3, the module on contracts. Again, as I've said several times before, contracts are the lifeblood of business. They're also very important in our day-to-day lives as consumers, obviously. So this is important and interesting stuff. Many of you are involved either as consumers or vendors or buyers. And so a lot of the information that we're going to cover in this brief 3-chapter module are things that you deal with on a pretty regular basis. So without a lot of further fussing, we're going to go ahead and dive in to the introductory chapter, chapter 21. And this is a chapter that is similar to the other pieces of the book that we've worked with, from the standpoint that we've got a very significant opening chapter that covers most of the material that we need to know, followed by 2 shorter chapters that will cover a couple specific issues in a little bit more detail. So let's dig in to chapter 21. And these are some things that we'll be looking at, and of course we're going to be introduced to the CISG. So our opening slide here, our opening significant slide for chapter 21, is the United Nations Convention on Contracts for International Sale of Goods. We refer to this in the business world as CISG. The easiest way to think of CISG is that this is the international version of our Uniform Commercial Code on Sales, Article 2 and 2A. There are some significant differences, and we'll be touching on them in this chapter and the following chapters. Now, what follows next is a set of 9 slides within chapter 21 that focus on the difference between common law and the Uniform Commercial Code. These are areas where the Uniform Commercial Code is dissimilar from the common law. And so this makes it a little bit easier to remember, because it's like, well, we know common law, most of us. Okay, here are things that we need to pay attention to because they're not the same as common law. So it helps you to learn the UCC at the same time. I wanted to mention that when I took my first business law course as a senior in college, and the professor, to my chagrin and sorrow, on the final exam expected us to memorize these section numbers, not just know this information, but actually know which section number. I've never thought that that was a particularly good way to teach any subject like this, where the key element I want is for you to understand this stuff, and then these specific numbers you can look up if you need to as you're going through this material in your day-to-day business practice. So, I mean, it's a very interesting situation, but again, we want you to focus on the concepts and not on necessarily the numbers. Again, they're all on Uniform Commercial Code Section 2. So again, comparing it with common law. In common law, we want a comprehensive contract. Uniform Commercial Code says most of the terms are there and we can kind of figure the deal out. It's okay. Now, I want to underscore here right up front, this doesn't mean it's really okay. It just means you can have an enforceable contract for goods under UCC that does not meet the common law standard for contracts. However, if you get to that point of the dispute, you've pretty much already lost. So from my book, we want to write contracts that are very comprehensive, that cover the waterfront. So the fact that you could do a little bit less doesn't mean you should do a little bit less. Firm offers by merchants are irrevocable for a maximum of 3 months. Again, most of the time, as long as it's reasonable, merchants have learned to put in a expiration date on their offers. In common law contracts, the acceptance is generally made by the way the offer is made to you. So if you are offered something by email, you're expected to respond by email. UCC says, we don't really care as long as you get the message back to the offeree, the offerer. And then unilateral offers may be accepted either by a promise to ship or by the shipment. Again, boo hiss, we don't like unilateral offers. We don't like unilateral contracts. One of the things to know is failure to reject may constitute acceptance. But acceptance by performance requires notice within a reasonable time. Again, not a big fan of acceptance by performance. We like to see fully executed contracts where the other side has said, yes, we are going to perform. That's what we like to see as business people. And then the variance in the terms between the offer and acceptance may not be a rejection and may be acceptance. Now, here's a critical element here with regard to Section 207 is when you have this situation in common law, remember we talked about the mirror image rule. The terms of the contract must directly meet the terms of the acceptance, mirror image rule. Key point here is the UCC does not require the mirror image rule. Again, not necessarily a great way to do business, but it means the contract may be enforceable even if it's not a mirror image acceptance. So watch out for that. Rather surprisingly, the price need not be included in a contract as long as you could figure it out through course of dealing or some other mechanism. Some other issues may be left open. Adding a seal is of no effect. Now, this is often, when we talk about a seal, oftentimes that's where you have a really big contract and the vice president or somebody at the senior level of a business is involved in signing off for the company. And it says, you know, this vice president has the authority to enter into this deal. But that's, you know, it's not really required for regular contract either. Consideration is not required in support of modification. Again, we talked about this in Module 3, is that for common law contracts, generally speaking, consideration is required if you make a significant change in a contract. It is not required under the Uniform Commercial Code. Under common law, a minor may disaffirm against an adult, even an innocent third party. UCC says no. And normally when you rescind the contract, you put it in rescission, everybody just goes away. UCC allows a recovery even under those circumstances. Now, remember in contracts that you can challenge a contract on a basis of unconscionability, but it is not an absolute. UCC says because good faith is required, by definition, if the contract is unconscionable, good faith is probably not involved. Now, keep in mind a tie-in between the statute of frauds that we talked about toward the end of Module 3 and the Uniform Commercial Code. We talked about the sale of goods has to be at least $500 for a written confirmation to be required. Again, the memorandum need not include all the terms of the agreement. Payment, acceptance, and receipt limited to quantity specified in writing. In other words, you can't enforce the purchase order for more than the amount stipulated. Of course, specially manufactured goods are binding because they're specially manufactured. And admission pleadings or court proceedings that a contract for sale was made, there's certain bases that you can document the existence of a contract. Now, under common law, you can separate rights and duties. Remember in our chapter on third parties, we talked specifically about that. We said that the assignment of the contract or rights under the contract can be done separately. Uniform Commercial Code, if you assign the rights, it includes a delegation of the duties. So it is different from a common law contract. Now, backing up again to contracts, and remember, modifications and amendments to the contract must have consideration in common law. Parallel to that, claims and rights may be waived without consideration under the code. Now, keep in mind, tender of payment is a condition precedent rather than a condition concurrent to tender of delivery, meaning that you have to say, I've got the money to a merchant before you can insist on saying you have not performed. And anticipatory breach is fascinating. Says may not be withdrawn if the other party gives notice that it's final. Under common law contracts, that's a gray area. Impracticability of performance in certain cases is an excuse for non-performance. What we want you to keep in mind here is in contracts, common law, it has to be impossible. However, under the Uniform Commercial Code, it just has to be impracticable. So notice the difference between the two. Now, the statute of limitations is pretty interesting. As we discussed in Module 3, in most states, the statute of limitations is, say, 2 years for an oral contract and 4 years for a written contract. The Uniform Commercial Code says it's 4 years, but the parties can reduce it by mutual agreement to not less than 1 year. Now, this is a good reminder that there are two parallel sections here. Article 2 deals with sales transactions, again, at least $500. Article 2A applies to lease of goods. Now, here's the key element to remember. This is not a simple short-term furniture lease from Aaron's Rental Furniture or something like that. What we're talking about here is a business that makes an accounting decision to lease goods instead of buying goods. And remember, what you've learned in your basic accounting courses is that if you are buying something that's a capital good, in most cases you have to capitalize that good, not all cases. But under a lease, you generally can deduct the cost of the lease on an ongoing basis. And so what a lot of companies do is they lease equipment so that they can keep more of their working capital in hand and can go ahead and pay for that without adding more overt debt. Although in most cases, the lease is a binding contract to make payments every month, usually for a 3-year period or something like that. So it's not clear that this really buys you a great deal more cash flow, but it may buy you some cash flow. But again, it has oftentimes better tax advantages. And I think we talked about this in the previous module, but remember that in a contract for sale of goods, for the UCC to apply, it has to be predominantly for the goods. So if you're buying a new air conditioner and it's $3,000 and installation is $1,000, the predominant value of that contract is the capital cost, the $3,000 for the purchase of the AC, not the $1,000 to install it. So that would stay under Article 2. So these are useful terms for you. Goods, items of personal property or physical. Sales, exchange of title to the goods for a price. That's pretty straightforward. Merchant, business person dealing in the subject matter of the sales contract. So if you're running a lawnmower and outdoor appliance store and you sell weed eaters and lawnmowers, then you're in that business. If you're running a local Goodwill store, that's not going to make you a merchant necessarily. Here's a couple more definitions. Again, under UCC, good faith is presumed. Note this on return goods, again, similar to what we looked at in Module 3. Sale on approval, goods are delivered primarily for use. Sale or return, goods are delivered primarily for resale. In both of these cases, there's an intention that if things don't work out, you can return them. Now, these are some very important abbreviations. Free on board, which we talked about in Module 3, comes back here. Free on board place of shipment. This is obviously the preference of the sellers. And then free on board the place of destination, that's obviously the preference of the buyers. And then free on board vessel, car, other vehicle. And in these cases, it must at his or her own expense risk load the goods on board. Most of my clients are not going to do that. They're going to say, no, you have to have a common carrier pick them up at our dock. So free alongside a vessel, this puts the burden on the seller to get the goods to the vessel. They have the risk until it gets on the vessel. At that point, the risk should transfer to the buyer. Again, let's not have that as a guess. Let's make sure that that is what's being done on an ongoing basis. Another term, so FOB is a very common term, FAS less well known. CIF, price includes the cost of goods, insurance, and freight. C, cost of insurance and freight are included. So when the CIF, price includes cost of goods, insurance, and freight. This is probably most commonly an acronym that you don't see, but that's kind of the Amazon deal. Although in some online orders I've seen where they tag you for a couple extra bucks and say, well, if you want this shipment insured, you've got to throw in a couple more dollars. But in most of the cases, they're representing to you that they're going to successfully deliver the goods to the designated location that you provide. So generally speaking, sales law parties are free to make their own contract, privileged to contract expressly regarding basic terms. And keep in mind this one. You cannot, as the seller covered by the code, relieve yourself of good faith, diligence, and due care. Good faith, diligence, and due care are part and parcel of any business contract, sales contract that is covered by the Uniform Commercial Code. Rather straightforward. Buyer's duty in a sales contract is pay for the stuff. That makes a lot of sense. Payment due in time and place buyer is to receive the goods. Now, having said this, many circumstances say that you've got 210 net 30, a very popular statement on the accounting side that says you can get 2% discount if you pay in the first 10 days, or you need to pay within 30 days the full amount that has been delivered. Now, we again talked about this in Module 3, documentary transactions. Seller uses documents titled control the goods until he or she is paid. And we use the example bill of lading of a warehouse. So you have 100 TV sets to sell. You don't want to keep them on hand. So you go to a bonded warehouse, public warehouse, and you put the TV sets on deposit. You get a negotiable bill of lading. You then sell the TV sets, not by getting them out of the warehouse and delivering them, but by selling the bill of lading that gives the holder title to those 100 TV sets. So that's, pretty much the way things are done. Now, these are, again, some terms that we introduced you to in Module 3 under the Uniform Commercial Code. Course of dealing is very important. How did you do business between the parties over the preceding time period? Usage of trade, if the direct course of dealing is not helpful, how is this normally done in the trade? And then a third part, course of performance, a contract that requires repeated performances. This is if you're doing something that you have done in the past, then that course of performance is certainly going to document that. So we give you an opportunity to take a little look at the Heller case. Now, keep in mind that this is a very common dispute that we run into. The seller and the buyer have different expectations of quality. Very difficult to resolve these situations. Bede failed the quality test with the buyer, passed the test with the seller, although the tests were slightly different. So buyer canceled the contract because the beads, because they failed the buyer's test for the beads. So it's a very interesting situation. So these are very typical, and the best way to deal with this, obviously, is for you to have an agreement as to what test will be used and who will administer it. Maybe identify an independent laboratory while you're negotiating the deal if something like this is likely to happen. And again, I saw a small business go out of business in a transaction like this, an international transaction. What happened is that the product was polymer scrap that had been converted from scrap plastic into little pellets, which is what is used in the polymer injection machines. And so it sounded like it was going to be a good deal. The stuff is shipped to China. While it comes off the ship in China, the buyer in China calls my client, who was in Houston, Texas, and said, hey, these beads are all different sizes. Now, why that's significant is, again, I learn a lot about little stuff here when I deal with various business issues over a long period of time. What happened in that case is the Chinese buyer sounded pretty legitimate. They said, the beads in the box is a big Gaylord, some multiple Gaylords, big, huge boxes. They said the beads are not all the same size. And the reason that's significant is if you're making better quality plastic items, you have to heat it for a specific period of time. The beads must all be the same size. So the Chinese said, we can make do with this, but it's basically scrap plastic that we can make cheap stuff with, but we can't make the nicer stuff because the beads are all different sizes. So it's a pretty interesting situation. Again, as a real life circumstance. Unfortunately, what the Chinese said is we can reject the whole order, or we'll give you a couple cents on the pound. So the seller here in Houston, took a dramatic loss on that order. And then it's a woman-owned business. She had another deal similar to that fell apart. And so with two fairly significant deals in a row, she went from being, prospectively a captain of industry to being out of business, sadly. And she was a international person, and she went back to her home country when this debacle came down. So a very sad case indeed. As we've mentioned several times during the course, I like these charts like this. So when you see these are, in my opinion, are ripe to move to your collection of special slides. And so again, huge difference between the Uniform Commercial Code and common law contracts is the ability to gap fill. Gap fill, not on the list under a common law contract, but the courts can write in a reasonable price. They can write in a reasonable quantity. Delivery is assumed to be at the seller's place of business, and a reasonable time for performance. So that's the gap filling. That's what we've got at this point. Now, when we talk about title, again, it depends on the nature of the beast. Automobiles and trucks have a VIN number, vehicle identification number. That's pretty much universal. Great situation. We know exactly that you're talking about this vehicle, not any other vehicle. But what about stuff that doesn't have a title like that? Well, one of the things that you can do is to identify things by their serial number. Most things that are produced in the world are stamped with a serial number that's unique to that item, so that if they're still willing to rock and roll, then I'm going to be out of the transaction. So let's take a further look at that. So here is tying into the previous slide, slide 25, this slide 26. Title to goods cannot pass until the goods have been identified to the contract. So it's a responsibility of the seller to specify the particular goods involved in the transaction. Again, if it's machinery, you should have a serial number. If it's vehicles, there should be a VIN number. And of course, agricultural items are a fungible good, so they're handled a little bit differently. Now you can see the significance of this first bullet. The loss will be borne by the party who has breached the contract. In one case, the buyer rightfully revokes acceptance. The risk of loss is back on the seller. Buyer repudiates the sale. Seller can impose the risk of loss on the buyer. So basically, the idea here is assigning risk of loss based on the free on board, the original agreement, but then by if someone breaches the agreement, there's going to be a little bit more leeway there. So keep in mind that with regard to risk of loss, generally speaking, and again, I have a client that will only ship from its dock, will not does not have its own trucks. Everything is done by common carriers or by proprietary trucks from the purchasing side. But basically, you have a situation where there is a free on board the shipping point, then the risk of loss for the whole time period after that is going to be on the buyer, because the buyer is supposed to be coming to the seller's point of location. In the free on board destination, risk of loss does not pass the buyer until the goods arrive at the destination and are available for the buyer for delivery. So this is a very important distinction between free on board shipping, free on board destination. Now remember, in a contract, you can negotiate this term. You can say, well, we're going to pick it up or send our common carrier to pick it up at your dock, but we want you to keep it insured till it gets to our remote dock. So we'll see how that goes. And then under bailments, the title to the buyer, the risk of loss passes to the buyer. Now, as we wrap up chapter 21, one of the situations we get into is the application of the CISG, which again, we introduced you to at the beginning of this chapter. And so this is again from the UN, and the CISG applies to countries. The parties to the contract have ratified it. Many members of the United Nations obviously have adopted the CISG, but not all of them. Now, an important caveat here, which may not be obvious to you, is the CISG only applies to non-consumer contracts for the sale of goods. So this is going to be merchant-oriented, unlike the UCC, which has got consumers and not very busy consumers who are businesses. Now, the significance of this is a good rule of thumb is if you're in the CISG, you're doing international transactions, the CISG frequently is more similar to common law than the code. Nothing is more vivid in that distinction than this first bullet. The CISG is guided by the mirror image rule. Remember, common law, mirror image rule. The situation, if you're If you're not here, you're under the code, the domestic U.S. Uniform Commercial Code. No such thing as the mirror image rule, and we just said this a few minutes ago. So this is why that's important, because it is a significant distinction between the code and the CISG. Even though the code works to expedite trade among the states, this operation leads across the world. So it's a little bit different, but again, it is a little bit confusing, unfortunately, and the best I can say is just kind of read through this and kind of work out those distinctions. Now, rather interestingly, the CISG does not follow the statute of frauds. The CISG declares that a contract does not have to be in writing to be enforceable, and consideration is not required to modify or terminate a contract. Again, recall that at common law, you must have consideration to modify the contract. So this is significant because it is more similar to in this case, it's more similar to the code in this one provision right here, bullet number 3, because consideration is not required to modify or terminate the contract. Remember, we just talked about this a couple slides back, and we said, if you're under the code, you do not have to have consideration to make changes. But again, CISG agrees with the UCC, although many other provisions, such as the two above, it's common law enforcement.